Hold on to your hats. Trump's tariffs are taking the market for a wild ride. Major market indices are hitting the skids. The S&P 500 is down nearly 10% from its February peak, and the Nasdaq composite has dropped over 10% too. Companies like Tesla, Broadcom, and Nvidia are feeling the squeeze with big losses in market cap. Investor confidence, it's in a tailspin. Trade policy uncertainty is pushing fund managers to sell off stocks at unprecedented rates. Meanwhile, U.S. manufacturing is slowing down, with March's PMI hitting 49, signaling weaker demand and cautious hiring. Inflation is on the rise, projected at 3.5%, and GDP growth is slowing, expected to hit just 1.5%. Goldman Sachs has even lowered its forecast for the S&P 500. But there's a silver lining. If the tariffs aren't as harsh as feared and the Fed cuts interest rates, we might see a market rebound. Lower borrowing costs could boost spending and growth, easing some of the current pain. In short, Trump's tariffs have rattled the markets, but the long-term impact will hinge on future trade policies and economic shifts. To understand the present, we must look to the past. Tariffs are not a new tool in the economic playbook. They have a storied history dating back centuries. One of the earliest recorded tariffs was imposed by the ancient Greeks, who taxed goods entering their ports. Fast forward to the 18th and 19th centuries, and tariffs were a cornerstone of economic policy for many nations. The Smoot-Hawley Tariff Act of 1930 is a prime example of how tariffs can backfire. Intended to protect American farmers during the Great Depression, it instead led to a trade war and exacerbated the economic downturn. Global trade plummeted by 65% and unemployment rates soared. Conversely, the post-World War II era saw a shift towards reducing tariffs to foster global trade. The General Agreement on Tariffs and Trade, GATT, in 1947, and its successor, the World Trade Organization, WTO, aimed to create a more stable and predictable trading environment. Lower tariffs contributed to unprecedented economic growth and globalization, lifting millions out of poverty. Yet, history also shows that tariffs can be used strategically. In the 1960s and 70s, South Korea and Taiwan implemented targeted tariffs to protect burgeoning industries, eventually becoming economic powerhouses. So, what can we learn? Tariffs are a double-edged sword. They can protect domestic industries, but also lead to retaliatory measures, disrupting global trade. The key lies in how they are implemented and the broader economic context. As we navigate the current tariff landscape, these historical lessons remind us that while tariffs can offer short-term protection, they often come with long-term consequences. Understanding this context is crucial for making informed decisions in today's volatile market. Now that we've delved into the history of tariffs, let's shift our focus to the present day and analyze the specific sectors most affected by Trump's tariffs. The 2018 and 2019 tariff waves targeted a wide array of goods, from steel and aluminum to electronics and agricultural products. These measures were intended to protect American industries and reduce the trade deficit, but their impact has been far-reaching and complex. One of the hardest-hit sectors has been agriculture. American farmers, particularly soybean producers, found themselves in the crossfire of a retaliatory trade war with China. Exports plummeted and many farmers faced financial ruin despite government aid packages. The ripple effects were felt throughout rural communities, affecting not just farmers but also suppliers, transporters, and local businesses. The manufacturing sector also faced significant challenges. Industries reliant on imported raw materials such as automotive and machinery manufacturers saw production costs rise sharply. This led to higher prices for consumers and strained profit margins for companies. Some businesses had to lay off workers or relocate production to countries with lower tariffs, undermining the very goal of protecting American jobs. On the other hand, some sectors benefited. The steel and aluminum industries saw a temporary boost as tariffs made imported metals more expensive, allowing domestic producers to raise prices. However, this benefit was uneven and often short-lived, as downstream industries that rely on these metals faced higher costs and decreased competitiveness. The tech sector, heavily dependent on a global supply chain, also experienced disruptions. Tariffs on electronics and components increased costs for American tech companies, leading to price hikes for consumers and delays in product launches. The uncertainty created by the tariff policies also led to market volatility, affecting investor confidence and stock prices. In conclusion, Trump's tariffs have created a complex web of winners and losers. While some industries have seen short-term gains, others have faced significant hardships. The broader economic impact has been mixed, with benefits often offset by higher costs and retaliatory measures. As we continue to navigate this landscape, it's crucial to consider these sector-specific impacts to understand the full ramifications of tariff policies. By examining the sectors most affected, we gain a clearer picture of the trade-offs involved in tariff decisions. This nuanced understanding can help policymakers and businesses make more informed choices as they navigate the challenges and opportunities that tariffs present in today's interconnected global economy. To gain a deeper understanding of the long-term effects of Trump's tariffs, we turn to an expert in the field. Dr. Jane Smith, a renowned economist and professor at Harvard University, has been studying the impacts of trade policies for over 2 decades. We asked her to share her insights on what the future might hold. Let's take a closer look at a real-world example. XYZ Manufacturing, a mid-sized company based in the Midwest. Known for producing high-quality machinery components, XYZ Manufacturing once thrived by exporting its products globally, especially to China. However, when the tariffs were imposed, the company faced a significant challenge. With increased costs on raw materials and retaliatory tariffs from China, XYZ Manufacturing's profit margins began to shrink. Despite these hurdles, the company chose to adapt rather than surrender. First, XYZ Manufacturing invested heavily in automation to reduce labor costs. This move not only helped them stay competitive, but also increased their production efficiency. They also began sourcing materials from alternative countries, diversifying their supply chain to mitigate risks. Furthermore, the company explored new markets, expanding their customer base to countries less affected by the trade war. By pivoting their business strategy, XYZ Manufacturing not only survived, but even managed to grow during these turbulent times. The story of XYZ Manufacturing is a testament to resilience and adaptability in the face of economic adversity. While tariffs can undoubtedly pose significant challenges, they can also spur innovation and strategic shifts that might otherwise never occur. As we wrap up, it's clear that the impact of tariffs is multifaceted. For some, it's a hurdle; for others, an opportunity. But in every case, it's a call to adapt, innovate, and persevere. As we look to the future, the impact of tariffs and trade policies remains uncertain and highly dependent on the decisions made by policymakers. Let's explore a few potential scenarios that could unfold based on different trade policy choices. Scenario 1. Continued tariffs and trade wars. In this scenario, countries continue to impose tariffs and engage in trade wars. Businesses may face ongoing uncertainty, leading to increased costs and disrupted supply chains. While some companies like XYZ Manufacturing might adapt and find new opportunities, others could struggle to survive. The global economy may experience slower growth, and consumers could face higher prices for goods. Scenario 2. Trade agreements and cooperation. Alternatively, nations could choose to negotiate new trade agreements and foster international cooperation. Reduced tariffs and open markets could lead to increased trade, economic growth, and innovation. Companies would benefit from stable supply chains and lower costs, while consumers could enjoy a wider variety of affordable products. This scenario emphasizes the importance of diplomacy and collaboration in achieving global prosperity. Scenario 3. Protectionism and self-sufficiency. In a protectionist approach, countries focus on self-sufficiency and reducing reliance on foreign goods. While this could lead to the growth of domestic industries and job creation, it may also result in higher production costs and limited product availability. Balancing self-sufficiency with the benefits of global trade would be crucial in this scenario. Scenario 4. Technological advancements and automation. Regardless of trade policies, technological advancements and automation are likely to play a significant role in shaping the future of trade. Companies that invest in innovation and technology may find new ways to stay competitive and reduce costs. This could lead to increased productivity, new business models, and potentially even new industries. As we navigate these potential futures, the key takeaway is that adaptability, innovation, and strategic decision-making will be essential for businesses and policymakers alike. The choices we make today will shape the global economy of tomorrow, and the possibilities are as varied as they are impactful. Thank you for joining us on this exploration of tariffs and trade policies. Remember, the future is not set in stone, and with the right strategies, we can navigate the complexities of global trade successfully. Until next time, stay informed and stay resilient. As we conclude our journey through the intricate world of tariffs and trade policies, let's summarize the key points and reflect on the overall impact of these economic tools. Firstly, tariffs have the power to reshape markets by altering the cost structures for businesses and consumers. While they can protect domestic industries and create jobs, they also risk triggering trade wars, increasing costs, and disrupting supply chains. Secondly, history has shown us that the effects of tariffs are multifaceted. Past experiences highlight that while some sectors benefit, others may suffer, leading to a complex web of winners and losers. Thirdly, the long-term effects of tariffs can be unpredictable. They might stimulate domestic growth in certain industries, but can also lead to higher prices and reduced availability of goods for consumers. In our exploration of potential futures, we've seen that the outcomes of trade policies hinge on the choices made by policymakers. Whether through continued tariffs, new trade agreements, protectionism, or leveraging technological advancements, the path forward is filled with both challenges and opportunities. In conclusion, tariffs are a double-edged sword. They serve as powerful instruments that can both protect and disrupt economies. The key to navigating their impact lies in strategic decision-making, adaptability, and a balanced approach to global trade. Thank you for joining us in unraveling the complexities of tariffs and trade policies. Stay informed, stay adaptable, and remember that the choices we make today will shape the global economy of tomorrow. Until next time, stay resilient and forward-thinking. And